In this session, I'm trying to talk about the wrong way risk. So it's a phrase which has emerged quite heavily during the 2007-8 financial crisis and whose significance has increased quite drastically during this period. The major thing is it tries to bring about an unfavorable dependence between two things. One, the exposure, the amount that we are losing, and the quality of the counterparty, the credit quality of the counterparty. So probably you can say exposure and the probability of default, exposure and loss given default. If the relationship between these is unfavorable, means it is going to increase the loss much higher because of the relationship between these two. That is what we are calling as wrong way risk. And if this relationship is more and more favorable, means it can reduce the loss because of this relationship. We call it as right way risk. So that's the difference, right? So the exposure becomes more and more higher when the counterparty is more likely to default. So if the credit quality of the counterparty is worse, the exposure is going to be higher and vice versa. Then we are talking of the loss increasing drastically, which is what is bringing out a wrong way risk. But if the dependence between the exposure and the quality of the counterparty is more and more favorable, that is where we talk about the right way risk. And right way risk should always reduce the counterparty risk, and it should also reduce the CVA drastically. Right way risk should reduce the CVA, wrong way risk should increase the CVA. But remember, when we have computed the CVA earlier, we simply use the formula like spread multiplied by exposure. Credit spread multiplied by exposure. Credit spread is a measure of default probability multiplied by exposure. Now, when we use this kind of a formula, the major intention was these two are independent. Whereas when there is a wrong way risk present, these two can't be multiplied like this, right? If we only assume that these two are independent, then only we can do a simple multiplication, which means I really need to understand the causes, why this wrong way risk is coming up, and what are the kind of implications. Whatever the current formula that I am using to compute my CVA, what is the kind of implication this wrong way risk brings with respect to I being able to estimate my exposure and being able to quantify the counterparty risk more and more effectively. So, if we have taken this particular formula, CVA equal to credit spread times the exposure, which we have used it as expected positive exposure, right? And as I said, this is based on a very key assumption that both of them are independent. But if they are dependent, the analysis becomes more and more complicated. And the above formula cannot be used at all. Because we are talking about the integration of default probability is a measure of credit risk and exposure is a measure of market risk. So we are talking about the integration of the credit risk and the market risk, which becomes very complex in task, right? So likewise, I can even think of finding out the relationship between the loss given default and exposure, or probably default probability and loss given default. So if any of these kind of dependencies, they giving scope for additional loss that is getting generated or increasing the loss of a particular institution, that is what is giving rise to the wrong way risk, right? So we are, to a large extent, in the derivatives market, we have underestimated the wrong way risk till the 2007 financial crisis. And the crisis has very clearly brought out that the wrong way risk can be extremely serious and it can shake the entire stability of the financial markets, right? So that's the initial start to get up. Now, let's look at some interesting aspects associated with the wrong way risk. Now, we have come to a conclusion. First of all, it's an unavoidable consequence. It is there as a part of the system, especially in the financial market. Look at some examples. Okay, look at the example of mortgage providers, the banks. So let's say they have given loans, right, to the residential house loan buyers or residential home buyers. They have given the housing loans and they have taken the house as a collateral. The same property they have taken as a collateral. Now assume a situation where there is a recession in the market. Now what could happen? When a recession occurs, now default on the loan is going to go higher. Means the probability of default is becoming higher. People lose their jobs, so they will default paying on their loans. But at the same time, because of recession, the property houses, the property's prices, the property which was kept as a collateral, the prices also go down. So there is a big chance of default. And when this default occurs, the banks may have to sell off the collateral and realize the money. But it is observed that the prices of the properties also go down drastically during that recession. So even if they sell, they get a much lesser amount for it. Overall, they are getting into a loss. Though they have taken a collateral, that collateral is not helping them in any way. That is the situation which we are talking of a wrong way risk, which is an unavoidable step. Similarly, in derivatives, there are so many such kind of trades that obviously contain the wrong way risk across the various asset classes. Now let's look at some kind of places where the wrong way risk obviously exists. Look at a put option, right? Now, if I had taken a put option, now let me link it with the counterparty risk. Right? If I have taken a put option on a stock where the underlying, so I have taken a put option on some X and X is having a lot of fortunes that are dependent on that of the counterparty Y. Now, is that not a wrong way risk? Because if the value of X falls, I get a protection here, right? But if the value of X falls, the counterparty's credit quality also starts deteriorating, which means overall I am ending up into a loss. Though I have taken a protection on X, the fall in the value of X is directly linking the fall in the value of Y, which is resulting in a counterparty risk for me in a heavier manner. So overall I will still get into a loss because my counterparty is not able to protect me, or my put option is not able to protect me here. So the more and more out of money the option is, the more is the wrong way risk that I am getting into. Very much possible. Had I gone for a call option, it could have been a right way risk. But going for a put option is a wrong way risk here. Similarly, think of forex forwards or any kind of cross currency products. Here also the same logic. Now I should try to find out the linkage between the exchange rate and the probability of default of the counterparty. This is the linkage I have to observe. So because if you see, let's assume a swap. Let's say the institution and the counterparty. Let's say the counterparty is receiving in some currency X which has weakened, and institution is receiving some currency Y which is strong. So now if this particular currency is weakened, the currency which the counterparty is receiving, if it is weakened, whereas the currency which he is paying, it has increased, then the default here, the counterparty is defaulting, and at the same time the currency is weakened, so he is ending up paying much more. So the loss for this particular party is much more, because the currency in which he has to receive is much higher compared to that of the counterparty's currency. So overall the total amount that needs to be received is much higher, which is a very good example of wrong way risk. Right? So wherever the same, the loan, I have taken a loan collateralized by the opposite currency. So if the currency weakens, the value of the collateral is decreased quite drastically, which is what again is bringing out the wrong way risk. Similarly, I can talk about the examples from the interest rate products. So I need to look at the relationship between the interest rate and the probability of default of the counterparty. So if the interest rates are much higher, then probably the counterparty can default, or even in some cases when the interest rates are lower also, that could be a scenario of a recession. Even there also the defaults can go up. So things can go in either way. In some cases when the interest rates are much higher, the default can happen straightforward. When the interest rates are much lower, that could be an indication of the recession in the economy, and that also can trigger the probability of default. So wrong way risk is possible, but again it has to be looked at contextually. Now, what about commodity swaps? Is the wrong way risk present there? Let's talk about a simple oil swap. So there are two parties, A and B, who got into an oil swap. So let's assume that A will be paying the cash flows based on a fixed oil price, whereas receiving, let's say, based on the average spot price of the oil during a particular period. Now, if the oil prices are rising drastically, what does that mean? The party which is paying fixed and receiving this, the exposure will be much higher for A, because the oil prices are rising drastically. So it looks as if B has to pay more to A. So the counterparty risk is going much higher. So if the oil prices are rising more and more, the exposure per A is increasing drastically. And so at the same time, if you say B is an oil company. Let's assume B is an oil company. So if the oil prices are high, it means that they are performing well. Right? If the oil prices are high, it means they are performing well. So if they are performing well and they have to pay more and more to the counterparty, then it can become a right way risk. So if the right way risk, if it is purely because of hedging, I can call it as a right way risk. But if it is coming purely out of speculation, it will get classified as a wrong way risk. right? So even it can come as a part of the commodity swap, or I can assume I can look at the wrong way risk even in credit default swap. This is a very common example. So A has given a loan to B. So B is exposed to credit risk. B tried to protect itself by getting into a credit default swap with C, where C will compensate B if A defaults. Now, if A and C, both of them default together, that is where the wrong way risk is coming into picture. So, if the exposure is coming because of the reference entity A's widening credit spread. Now, if there is a strong relationship between the credit quality of the reference entity and the counterparty, then there is a very high wrong way risk that is going to come up. So in this case, instead of buying a CDS protection, I should sell a CDS protection which could give me a right way risk. Because in this case, the counterparty risk will not exist, it will be reduced, and my CVA value also will reduce drastically. Now, these are the different kinds of examples where we see in the derivatives market. Wrong way risk is something that I can't avoid, I have to live with it, but I really need to understand it and price it appropriately so that I take the relevant action to mitigate it at the right time. Now I have to touch base upon right way risk, which is a risk which is more and more favorable. So there is a kind of a favorable or a beneficial relationship that is existing between the exposure and the probability of default. And because of this beneficial relationship, the counterparty risk should actually come down. So if we are talking about the world of hedging, even as a natural definition, it is creating a right way risk, and because of this, it is going to reduce the risk altogether. Because we are reducing the uncertainty regarding the quality of the counterparty. And logically speaking, wrong way risk should not be that frequent, it should be very rare. But if I assume that most of the counterparties are hedging rather than speculating, there should be a very high amount of right way risk and very low amount of wrong way risk. But that is not what we have observed in the market in the recent time. In the real world, speculation, failed hedges, and systemic effects. Three things. Speculations were much higher. Whatever the hedges that were performed, they were failed, and the systemic effects got created. All these are a very clear indicator that the wrong way risk is occurring more and more frequently compared to the right way risk. Now, okay, I do understand now wrong way risk is very much inevitable. Now, how do I really quantify it? How do I measure the wrong way risk? So this is where I really need to get into the modeling of the relationship between the probability of default and the exposure. Now they are no more independent. So I have to get into the modeling of the relationship between the two. But the problem comes, I don't have the historical data which can support this. So because many a times it's not revealed at for any historical time series data, I cannot really establish any such kind of relationship between the two. Or many a times there could be a lot of misspecification associated with this relationship. The relationship may be very much inappropriate, right? So in some cases I may be looking at a correlation and say there is no correlation between them. but there could be some kind of causality relationship that can exist between the two. So it is very difficult to quantify because of these reasons. And also, if I go with the historical data, wrong way risk is generally very much extreme. I look at a very serious consequence coming up, and it's more and more specific. So historical data may or may not show this kind of relationship perfectly. And even when I am looking at misspecification per se, I am using correlation as a measure to find out the relationship between the probability of default and the exposure. But we have to understand correlation only measures the linear relationship between the variables. There could be a second order or a third order relationship that could be existing. Means there could be a kind of a causal relationship which may not be captured by correlation at all. So some of the challenges that are there with respect to the quantification of the wrong way risks need to be understood and appreciated before we actually go ahead in terms of modeling the same. Then when we look at CVA, and I try to link the wrong way risk with it. Now if at all the wrong way risk is present, CVA should be more and more because the risk is increasing. But again, it will be very difficult to quantify the same, right? And which means I can't use the simple formulas which we have used for computing the CVA earlier. But still, if I want to talk about conditional, right, CVA conditional on default, then I can still use that formula. I can use LGD times the discounting factor at time period Tj, and I can multiply it with the expected exposure at time period Tj, given that there is a default that has occurred at this particular period. Given that the default has occurred, then I am multiplying it with the probability of default during this particular time period. So conditional CVA can still be computed. I'll replace the expected unconditional expected exposure with a conditional expected exposure, right? So that's one more way we can look at the computation of the CVA in the presence of the wrong way risk. And few important points: if there is a positive correlation between the probability of default and exposure, right, probability default and exposure, if there is a positive relationship, so obviously your conditional expected exposure is going up because the default probability is higher when the exposure is higher, which is what is a wrong way risk. Whereas if there is a negative correlation between the two, that could cause the right way risk. So we have to be in a position to assess the relationships and then do the positioning accordingly. So this is what we can understand from the wrong way risk, what role it has played, and how do I really get into the measurement of that, and some few examples with respect to the financial markets. Thanks a lot for listening to this session. Thank you very much.